Welcome back. Lot to unpack, lot to talk about. This week, CPI headline inflation hitting 2.6%. That is a big number that beat out a lot of expectations from analysts and economists, with the Bank of Canada even predicting that we were supposed to see inflation tick up to 2.5 in March. And ultimately, with the next Bank of Canada meeting set in just the next couple weeks, we also have the tariff conversation coming in on April 2nd, that reciprocal tariff conversation and what it could mean for the Bank of Canada. And if we tie all that in, what does it mean for interest rates here in Canada, especially for millions of Canadians that are approaching mortgage renewal, wondering what options to select? Should they go 3 or 5? Should they go shorter? Should they go fixed or variable? This week, I want to take an opportunity to go through our thoughts and opinions on the matter. So stay tuned. Once again, welcome back to the channel. If you have not yet subscribed, we invite you to subscribe to the channel, hit that notification bell so you can stay up to date with everything that's happening in the mortgage and real estate marketplace, especially with all the conversations now with tariffs and inflation. Now is really the time to stay informed and up to date, whether you're purchasing a home, whether you're looking at your mortgage renewal or options. If you want to stay up to date, it's always good to stay informed. So don't forget to leave your thoughts, questions, and comments in the comment section below. Let's get right into it. Ultimately, right now, many Canadians may have heard or seen that the inflation has ticked up to 2.6%. That is the headline inflation number. That is basically what we see. Now, ultimately, the bigger concern, that what lies beneath that, is that core inflation, the measurements of core, medium, and trim, those numbers are super important to the Bank of Canada. And those are the numbers that the Bank of Canada pays really close attention to. And those numbers have accelerated over the past few inflation prints. And this is ultimately problematic for the Bank of Canada. It couldn't have come at probably a worse time, because now not only are we battling the potential for higher inflation here in Canada and economic uncertainty, but we're also battling another front with these tariffs that are set to come in on April 2nd. And ultimately, if we pull all this data together, it doesn't really paint a positive picture for the next or the short term, potentially even mid to long term here in Canada, unless we get some resolve. So ultimately, we'll kick off things by talking a little bit about the inflation print. Things are getting a little bit more expensive in certain segments. And we've talked about the things around inflation, what could be causing these CPI headline inflation numbers, core, medium, and trim numbers to tick up. If you recall, over the past little while, we had this thing called the GST HST holiday, and I hope many Canadians took advantage of that. I know when you went to the grocery store, went out for dinner, you did get a chance to see that tax break. Now, ultimately, as this is no longer in play, we're getting a more true picture of what is happening with inflation. So we also have the fact that when Donald Trump got elected in November, became the 47th president on January 20th, that many businesses had understood that tariffs were going to be a real threat. And with that, we've talked about this bringing on, or sort of front running the market. So if you were importing and exporting goods, you were probably trying to get your goods and services, done before any of these tariffs kick in. And this is something the Bank of Canada governor had talked about last week. If you haven't watched that episode, we encourage you to watch it right after this one. But ultimately, right now, we have a lot of pressures coming in because we see that if these tariffs come into play, obviously this tariff, this reciprocal tariff, a lot of up and down, in and out. This is really the uncertainty part of it. But ultimately, if we see all that, if we see Canada retaliate with tariffs of their own, basically tit for tat, if we see them, bouncing back and forth, well, that implies that it's around $600 billion of Canadian goods that are coming in, or from the US coming into Canada, are going to be much more expensive. And that ultimately leads to higher prices for people like you and I. And ultimately, well, that obviously will tick up inflation, right? Because if you're paying more for something you're paying less for, that's going to show up in the numbers. Now, maybe the Bank of Canada, most likely the Bank of Canada, is going to look through some of these numbers because they can, most likely because of the fact that they know that they're cost, the reason why they're up, is because of those tariffs if they kick in, and ultimately they will look through it. But if we see a prolonged period like this, if we see that continue to bleed into the Canadian economy, well, that's going to be even more problematic because of the fact that, here in Canada, we have to understand that employment is key, right? So when we talk about recessions, we talk about things that are going to happen. Obviously, we use the textbook definition, 2 consecutive quarters of contraction in GDP and growth. But ultimately, you have to understand that as the unemployment ticks up, that can send the Canadian economy into a recession. And although the unemployment rate has remained relatively steady right now, once these tariffs kick in, we have to understand that there is going to be a much higher probability that Canadians are going to be losing their jobs, especially if we see it in the automotive sector. A lot of businesses right now, keeping in mind that around 2/3 of businesses employ the majority of Canadians. So those businesses are not investing in hiring. They're not investing in training, in productivity measures, technology, because they're conscientiously, looking at the future, saying, hey, we better hold on to our cash piles, our capital, because we may need them to stay open, right? To keep our doors open. So this is super important to understand. That obviously leads into consumer sentiment. People like you and I, if we're scared about losing our jobs or scared about the cost of things going up or down, well, there's two things that are going to happen. Either you're going to put more money aside for the rainy day, or you're going to potentially buy those items that are more expensive, or you're going to perceive them to be more expensive if the tariffs kick in now, which can drive up inflation and obviously consumer spending and sentiment in the short term, right? So we have to understand all these mechanical things that are moving around in the economy. So what does all this mean, right? So with inflation, core numbers, you see where some of the things are getting more expensive. Once again, this is one set of data. I mean, we do have some indicators right now. Remember, most of the data that we're looking at is lagging, right? It's previous months of data, but ultimately this is a good leading indicator. Could be a canary in the coal mine. And ultimately the Bank of Canada, their framework, their mandate, just to talk about what we talked about last week, and we sort of said this was going to happen in the sense of the conversation. We were talking about interest rates potentially going up last week when everyone was talking about rates coming down. And now with the inflation print, well, that conversation gets ignited because the Bank of Canada's framework, much to Governor Tiff Macklем's conversation, he did mention that, look, we need to keep price stability. We need to keep price pressures down. Here in Canada, the Bank of Canada can only do so much.
Monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. The focus of the Governing Council will be on assessing the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time.
Right. The Bank of Canada can obviously lower interest rates. They can, print more money, quantitative easing, and they can give forward guidance. Well, I think quantitative easing right now is off the table. The Bank of Canada is cutting interest rates. The one thing that we're not getting much of is the forward guidance, right? Because these tariffs haven't kicked in yet. Once these tariffs kick in, then we may get some forward guidance. But remember, the Bank of Canada is going to tippy-toe, be very, very cautious on what they say. But ultimately, right now, all this uncertainty is leading to the possibility that the Bank of Canada will have to hike its policy rates. Maybe not in the short term, maybe not in the midterm, but definitely if we look at the Bank of Canada, they're going to shoot now, ask questions later. And you might be saying, Anth, what do you mean by that? Well, ultimately, if tariffs kick in, the Bank of Canada is going to do whatever they can with whatever resources they have at their disposal to bring those interest rates down, to continue to make the economy chug along, right? They want to sort of ignite that. In the long term, right, if inflation continues to rise, well, the Bank of Canada may have to slow that down a little bit in order to make sure that price growth does not continue to accelerate. And then the Bank of Canada may have to really hammer down. And the Bank of Canada is really pointed to, some studies are pointing to the bank may have to increase interest rates by 1%, 1.25%. Ultimately, it's really too soon. But with all this uncertainty, for a lot of Canadians, when you're going to select that mortgage at renewal time, and we're getting a lot of this conversation with our clients, it's fixed, variable. Anth, what do you think? And ultimately, the most important thing is, what is your thesis? What is your belief that's going to happen? Is the Bank of Canada going to continue to cut rates? Are they not? Are they going to pause? And is that going to change the outcome of what you think is going to happen? What's your prognosis, right? Is the Bank of Canada cut another quarter, 0.5%, 75? I mean, I've heard it all. But ultimately, if you think about it, what rate can you get today right, versus what the variable is. As the delta between these two rates continues to shrink, the spread between these two rates continue to get very close. Well, you have to really understand your appetite for risk. And a lot of times, a lot of first-time home buyers, they have a budget. Some of them are really, really living on that razor's edge. One, situation pops up, a car expense or something with the home, that throws them into turmoil, where, they're leveraging lines of credits and credit cards. A lot of Canadians that we have talked to, unfortunately, over the last couple of years, 5 years, especially as these mortgages are coming up, maybe you've had a child, maybe two, one person's returning back to work, or they've, incurred a lot of debt at that time when there was, only one person working with more mouths to feed. So you have to understand the circumstances. So a lot of Canadians might be restructuring and looking at it saying, hey, I was paying this. Yes, that rate might have been much lower than where that rate is today, especially if you were sub 3. Now you might see, maybe around that high 3, depending on what the product is, to low 4s right now for a 3-year product. We'll do a rate update in order to get the more comprehensive rates out to our clients or to our viewers in the next little while. But ultimately, right now, when you're thinking about it, understand the size of your mortgage, understanding the swing in those payments. If it's going to be monumental one way or the other, you have to understand and have a budget in place to be able to absorb those changes and those payment shocks. Obviously, depending on the type of variable you have. We've talked about this multiple times, but I think it's super important when we get calls. Obviously, there's a variable which is called a true variable. We call it an adjustable rate mortgage, where when the Bank of Canada cuts or increases the payment on that mortgage based on the lender that you have, their prime rate goes up or down, your payment would move in tandem with it, right? So up or down. Then you have what's called the static trigger rate mortgages, where the amortization we saw was sort of ticking up 50, 60, 70, yada, yada, yada. And ultimately, now that interest rates have come down on those products, they've aligned a little bit better. But a lot of Canadians, wanted their payment to stay where it was. Basically, it's fixed. It's a fixed payment. Now, ultimately, what that means is you don't get to see your savings month to month, but you see them on the back end of the mortgage. So that's super important to understand. So in this conversation, ultimately, it's understanding your risk appetite, your argument, your thesis for what is happening. 3, 5 years, do you think that things are going to change in the long term, in the short term? And when you're selecting that product, it's always best to look at that payment. If there's a $20 or $30 or $50 difference per month, yes, it can add up to a lot over 3 or 5 years, but you also have to understand what type of security, what peace of mind are you paying for between a fixed and potentially a variable, and how well will you sleep at night knowing that you really can set it and forget it. Because when it comes to variable rate mortgages, a lot of Canadians have to be in tune with what's happening. And by the time things sort of pop up, right, when you start to see things happen in the media, well, then it might be already too late. And, you have to sort of be in touch with what's happening. So that's why you should subscribe to the channel. Keep keeping yourself up to date with everything that's happening, our opinions and our thoughts. Let us know what you think in the comment section below. Fixed, variable, what would you be doing? Have you renewed your mortgage? What did you select? Let us know in the comment sections below. But until next week, thanks again for stopping by, and we'll see you next week.